Good morning and welcome to your Tuesday, April 9th market news update. The Reserve Bank of New Zealand's interest rate decision lands in tomorrow's early Asian session. The yen edges closer to the 152 key record level despite calls for intervention by Japanese authorities. TSMC receives grants and loans worth up to $11.6 billion from the US government. The EIA showed Energy Outlook the point of attraction for crude oil traders. The greenback stands muted near two-week lows as investors praise CPI data. Netflix is set to undergo restructuring changes in its film departments to boost competitiveness. Finally, the Loonie sticks close to 4-month low levels, ahead of BOC's monetary policy decision tomorrow. That's all for now, and stay tuned for tomorrow's market update.
Hi everybody and welcome to another daily presentation. This is the market overview for the 9th of April of 2024, and these are the key events that you should familiarize yourself before starting your own trading day. Now, the first and sole topic of the day is going to be about the incoming RBNZ's interest rate decision, which comes up in tomorrow's early Asian session. So Kiwi traders will tune in for the Reserve Bank of New Zealand's monetary policy decision in order to get a better grasp on the future trajectory of the antipodian currency and, in a sense, get a grasp of what RBNZ policymakers are thinking about their future monetary policy outlook plans going forward. So this week, the New Zealand dollar has rebounded from a 4-month trough and crossed above the 0.60 range against the United States dollar as we continue to see the greenback showcasing signs of weakness, at least this week, and experiencing, in a sense, waves of outflows. Now, in regards to the decision, market foresees that the central bank will extend the pause of its tightening campaign for the 6th consecutive session and keep the official cash rate steady and unchanged at the 5.5% level, which is a near 15-year high, as we continue to see price pressures still hovering more than 2 times higher than the bank's 1 to 3% goal or target. So unfortunately, the most timely and accurate data in terms of inflationary pressures and trends in the New Zealand economy is going to be released next week. Therefore, we will assess the situation given what we currently have in our hands right now, which are the data from Q4 of 2023. So headline inflation in New Zealand was reported at the 4.7% level in the fourth quarter of 2023, recording a cool down from the 5.6% level of the prior quarter. So we're talking about Q3 here, and has, in a sense, partly relieved some sort of stress off RBNZ's policymakers' shoulders, but ultimately sticky household and utilities, rent, as well as food inflation continue to remain stubbornly high and many times above the bank's target. Therefore, they continue still to impose a severe problem, a systematic and systemic risk for everyday New Zealanders. Okay, so RBNZ policymakers stated in the past meeting that the OCR, the overnight cash rate, needs to stay at restrictive levels for longer, okay, to return inflation back towards the target. And this was, in a sense, broadcast at the January meeting, but at that point in time, also we saw the removal of the wording that pointed towards to potential additional rate increases. That's not in the picture for the time being. And this, in a sense, indirectly signals that policymakers are telling the market that they will be most likely holding the OCR unchanged for a prolonged period of time in order to make sure the inflationary pressures move back towards the target. And in a sense, this is their go-to plan for 2024. However, money markets have a different take on this kind of matter. No surprises there. So even though we continue to see NZAD OIS probabilities assigning a 98% chance for a pause scenario at tomorrow's meeting. Economists from there onwards foresee that the central bank will pivot towards looser policy conditions, primarily taking place in the August meeting. And there is going to be a slashing of the overnight cash rate by 25 basis points. At least that's the view of the market. And from there onwards, in a sense, we expect to see another cut, so 2 cuts in 2024. But the point here is that the markets or money market participants or economists or forecasters are going against the grain. Again, this is not surprising. We have observed this from many other major central banks since the start of this year. Okay, so it matches the theme, and we have to keep an open mind here. We have seen, for example, the Federal Reserve, more specifically money market participants, and their stance against or towards to the policy actions of the Federal Reserve kind of being diluted. So we expressed this many times in the past. Since the start of the year, money markets foresaw 5 cuts by the Federal Reserve. The Fed, in contrast, was looking at 3, and now 4 months down the line, we see money markets kind of moving towards to the projections of the Fed. So leaving behind the scenario for 5 cuts and matching the 3 cuts that the Federal Reserve has set. So we may be getting the same kind of scenario from RBNZ as well, money market's point of view towards RBNZ. So no cuts scenarios kind of coming into fruition rather than 2 cuts that the market expects. So we expect, in a sense, in other words, in much simpler terms, the divergence between the market's views and the RBNZ to align over time. Shall we continue to see inflationary pressures maintaining that kind of stickiness and not failing and not moving closer to the bank's targets? Okay, so furthermore, we have to close by this. Money markets or economies foresee another cut of equal magnitude, so 25 basis points, taking place in October. So we have one projection for August, and the other one is for another cut of equal magnitude taking place in October. So in a sense, this leaves a terminal rate, a key overnight cash rate, a key OCR rate by the end of the year, hovering near and about the 5% level. So a shedding of 50 basis points is currently expected by the markets. We will see whether this kind of scenario will remain. But at the end of the day, these projections, okay, by money market participants, that they foresee cuts are going to be taking place, at least from their point of view, in 2024. This creates this, creates a negative kind of veiling around the Kiwi, expecting it, in a sense, to weaken, okay, and move to the downside, which, again, that's why we may see a negative reaction towards the Kiwi dollar in tomorrow's session and a sharp contraction and plunging, in a sense, further lower. Shall we, for example, get RBNZ's decision staying on hold and saying we may be considering cuts in 2024? Highly unlikely, but that could come into fruition. For the time being, there's not much else to discuss. So therefore, this brings us to the end of today's session, guys. Thanks for watching, and we'll catch you on to tomorrow's session for another, hopefully brief update. Take care. Bye-bye.
In this video, we will discuss how you can open a demo account with T4Trade to practice your trades. Forex trading has gained significant popularity worldwide, and as a result, people can now easily access online resources to expand their knowledge. T4Trade, a well-known global Forex broker, provides an array of educational resources through its T4Trade Academy. These resources comprise ebooks, webinars, seminars, and on-demand videos. Moreover, T4Trade also offers informative articles and blogs, along with a helpful FAQ section that addresses many of the questions commonly asked by traders. T4Trade has globally gained popularity among traders due to various reasons. This includes flexibility leverage, tight spreads, quick trade execution, prompt withdrawal processing, and outstanding 24/5 client support available in multiple languages. T4Trade also provides access to a vast selection of over 300 financial instruments across 6 categories of assets, including Forex, metals, futures, shares, indices, and commodities. To gain a better understanding of trading with T4Trade, you may consider opening a demo account to practice your trades on its MetaTrader 4 platform. The demo trading account offers important features such as a safe environment for trading currency pairs without the use of personal capital. It imitates actual market conditions, providing crucial understanding of the complexities of Forex trading. New traders can practice a variety of trades to gain more knowledge and skill, while experienced traders can improve their existing expertise for increased profits. Opening a demo account can assist you in comprehending how to use the MT4 platform. This involves activities such as placing orders, analyzing price movements, evaluating chart patterns, and testing leverage, among others. In conclusion, opening a demo account with T4Trade is a straightforward process that can quickly be done and easily through the website. By clicking on the Open a Demo Account button and filling out the required form, traders can build their confidence before trading with real capital. With access to various educational resources, market insights, and a risk-free environment, traders can develop their skills and gain confidence before trading with real money. So don't hesitate to try out a demo account today and take the first step towards becoming a successful Forex trader. Thank you for watching.
Okay, so welcome guys. This is another webinar on our series. We're going to go and venture into technical analysis a little bit more deeper today. Over the past, 5-6 sessions, we have been introducing or reintroducing a few concepts that we have went over the past. Okay, more specifically, we went over for example, once again, moving average strategies. We went over how to plot RSI onto your charts, how to interpret it, and all that kind of lovely stuff. We went over support and resistance levels, trend lines, identification of chart patterns, and MACD as well was something else we've done over the past, if I'm not mistaken, it was the last one or the one before it. Irrespective, the point I'm trying to make here is that over the past 5 or 6 sessions, we've been reintroducing concepts, and then we were going over on a live environment today and actually putting all those kind of stuff to work. We're going to do the same thing today, but let's not go ahead of ourselves, get ahead of ourselves. The topic for today is going to be Fibonacci retracements. Okay. Fairly quote unquote complicated topic in trading. I don't share that view. I think it's pretty straightforward. Hopefully, I'm going to convey this kind of information in a much simpler and easy way for you to digest. And if you feel free, go on and apply it to your charts and make use of this. Okay. So, again, I see a lot of people start to join as well. Okay. Mofawaka as well. We see. And Gemnu, I'm sorry, man, if I'm butchering your name. I see Sarah once again joining. Welcome, guys. We haven't started yet, but we will now. Okay. So today we're going to go over Fibonacci, concept of Fibonacci, and then we're going to go into the Fibonacci retracement, which is a method or a tool or an indicator that traders like to use and apply to them charts for either identifying support and resistance levels, entry and exit points, and all that kind of lovely stuff. Okay, so this is the topic for today. After we go over the theoretical part, we're going to go into a live environment, and you will see the whole thing together. Okay, so before we rally through the whole thing, please let me go over a quick risk warning and a disclaimer. I have to get this through as soon as possible at the start of the session in order for us to roam freely into today's topic. Okay, so the risk warning is our products are traded on margin and carry high level of risk, and it's possible to lose all your capital. Now, these products may not be suitable for everyone, and you should ensure that you understand all the risks involved. Now, the information in this webinar shall not be considered as investment advice or investment recommendation, but it is for educational purposes only. The material is just a personal opinion of the author, and the client's investment objectives and risk tolerance have not been considered. T4Trade is not responsible for any loss arising from any information contained herein, and the redistribution of the material is strictly prohibited. Okay, so now that we got this out of the way, let's do a small recap of where we are. Okay, so we stand under the branch of technical analysis, and more specifically, we're going to venture into mechanical analysis. Okay, so the other one is charting analysis, which in a sense you can draw onto your charts trend lines and support and resistance levels and all that kind of lovely stuff, identifying patterns, identifying formation of candles, interpreting individual candles or candles in a bundle. Okay, so today we're going to go into mechanical analysis, which are what we call technical indicators, and they are adopted or used or plotted on either on top of price action or below your chart. So there are different indications that they're trying to assess how the whole thing is going unfolding in front of your eyes, not just pure price action. They give you indication about whether the sentiment is bullish or bearish, whether you're going to have some sort of overextension and you're going to get the reversion towards the mean, where you have overbought or oversold conditions and all the kind of lovely stuff. Okay, these are conveyed through a plethora of different indicators. Over the past, we went most of them. So if you look at the presentation slide, you have moving averages with an asterisk. The stuff that have asterisks as the ones are the topics that we have covered in the past. So we went over moving averages and moving average strategies in a much quote unquote deeper level. We also visited Bollinger Bands, which have two of them go on top of the price action, much like the topic that we will discuss today, the indicator that we'll discuss today, Fibonacci retracement. It goes on top of price action, and below the or off the chart, you get RSI, moving average convergence and divergence, momentum, and other kind of oscillators. Average directional move is another one. But over the past, we went over 1, 2, 3, 4, and today we're going to go over the fifth one. Okay, and please bear in mind that after we go over the theoretical part, we're gonna adopt and use and plot onto our charts moving averages, yep, Bollinger Bands, yep, RSI, yeah, or we're gonna do MACD. Okay, so one of the two, or why not do both? Okay, on top of the whole Fibonacci retracement tool. Okay, so enough about this. Let's go into Fibonacci in general, and then Fibonacci retracement. So Fibonacci in the grander scheme of things, is considered to be a sequence, and that's what essentially is. And by using that sequence, you get what we call the Fibonacci ratios, which are what the Fibonacci retracement tool is using. So please bear in mind, we're going to go from the beginning. So Fibonacci sequence was identified by an Italian mathematician, namely Leonardo Bonacci, in the 13th century. However, it was widely believed that Bonacci, did not create the sequence, but he was introduced to the concept by some Indian merchants. Folklore or reality, who knows? The point is, what the aftermath is, in a sense, the Fibonacci sequence. Okay, so the origins of the Fibonacci sequence can be traced back to the 6th century BCE, so in ancient India. Okay, again, kind of irrelevant, but still. The Fibonacci sequence is also closely connected to what we call the golden ratio or the divine proportion, which is something that we interestingly find in pretty much nature all around us. Has to do with some aesthetic pleasing of our eyes. Our eyes unconsciously detect this kind of ratio, whether we like it or not. That's why we call some people attractive, or that's why we see a piece of art or architectural building that, says, oh, wow, this is very nice. Most of them, or if not all of them, have been constructed, or they are like they are because they fulfill what we call, or they adopt, or they use what we call the Fibonacci ratio or the divine proportion. Okay, so it is interestingly found in sunflowers, galaxy formations. You can find it in historical artifacts, in architecture, in shells, in human anatomy as well. There's a lot of different things where you can spot this kind of ratio, indirectly or directly, conscious or unconscious. Okay, so in a sense, the Fibonacci sequence starts with its prime culprits, if you like, or the starting point of the Fibonacci sequence has two variables, 0 and 1. Okay, so how is it constructed? You add, in a sense, the first two together, the 0 and 1, and then you subsequently add the new number with the newly created number with the former one. In a sense, you go from 0 plus 1, you get 1, 1 plus 1 gives you 2. You can see my mouse pointer, hopefully. Yeah, 1 plus 1 is 2, 2 plus 1 is 3, 3 plus 2 is 5, 5 plus 3 is 8, 8 plus 5 is 13, etc., etc., etc. It goes on indefinitely. Okay, so this is in a sense what we call the Fibonacci sequence, taking the first two numbers, adding them together, the 0 and 1, and after that every subsequent number is added with its predecessor. Okay, so much like the fashion we just discussed. Okay, so hence this is how the sequence is created. Okay, now going beyond the sequence, why do we care about this when it comes to trading? Some people, I'm not sure about the history of this, back in hopefully the 90s, if I'm not mistaken, the 1980s or 90s, they have started implementing new and novel techniques of going at trading, or in a sense, attempting to evolve the art of technical analysis. They stumble upon Fibonacci sequence, and then they extracted what we call the Fibonacci ratios, which are used in the various Fibonacci tools, much like the Fibonacci retracement, extension, expansion, and all that kind of stuff. Okay, so in a sense, what they've done is divided. You're going to see how exactly those ratios are formed in the next slide. So in a sense, the ratios that we use are created from the Fibonacci sequence. Okay, in a nutshell, that's what we do with it in the financial markets. Okay, so when it comes to trading, practitioners commonly use this ratio, the 1.618, the one I failed to mention, the golden ratio, and other related ratios. You're going to see them soon, to establish support and resistance levels, or at least possible areas where you would reasonably expect, reasonably it's in quote unquote here, where would you expect to see some sort of stalling or acceleration of price action? Okay, either bouncing from that level, prices bouncing from that level, or resisting, breaking past those levels. Okay, what we call in traditional terms support and resistance levels. Okay, and they use these Fibonacci ratios on the place, in a sense, the Fibonacci tools on top of market waves in order to predict, in a sense, where the price action might stall in the near future, or where the price action is going to move towards to if it breaks a formerly high level that it has an uncharted territory ahead of it, where we might expect to get some sort of resistance afterward. If I'm confusing you with this, please bear with me. You're going to see what I mean clearly in the next few slides. Okay, so in a nutshell, what are the key ratios? We're going to see them soon. Is the 0.618 or the 61.8% level, the 0.382 or the 38.2% level, the 0.236 or the 23.6% level. And those are the three most crucial ones. And in trading, because we like integers and we go from, we like percentages and all that kind of stuff, we use the 50% or the mid-level as another key Fibonacci ratio, but also the 100%, the full control, okay, which in a sense gives you an indication whether the price action has reversed entirely from a prior pullback or a setback, and etc. Again, I'm going way ahead of myself here. Please bear with me. So Fibonacci sequence, as again, starts with the number 0 and 1. You add the one, you add the new number with the prior one, and hence you get this Fibonacci sequence. Fibonacci ratios are found by dividing any number in the sequence by, okay, the number that immediately follows it, and you get the 61.8. The number after 2 places gives you the 38.2, and after 3 places you get the what we call the 23.6%. Okay, so imagine you have, let's go back, you have the number, you start with the number 13. Okay, so you divide 13 by the one after it, so 21. Okay, if you pull up your calculators up right now, or let's do it together right now. You're going to see what I mean. Together. Okay, so we make a start with 13, and then we divide it by the next one, which is the 21. It gives you the 0.618. Okay, it's obviously rounded up here to 619. You get the point. Let's do the 89 divided by 144. It's going to give you 0.618. That's how you get the ratio. And let's go with 89 divided up by the 2 numbers ahead of it. So 233, you're going to get the 38.2. Okay, 0.3819, excuse me, round that up to 0.382. That's how you get the 38.2% level, what we call. Okay, and then let's go for the 89 divide that by 377. You get the 23.6 level. Again, note the levels we just mentioned here. That's how you get the ratios. Okay, and no matter where you are in regards to the sequence of numbers, once you do this key procedure, so dividing the current number by the next one that follows it is going to give you the 618. Dividing the current number by the one that is 2 seats after that is going to give you the 38.2. Dividing the one you have in front of you right now by the one that is 3 places down the line, you're going to get always what we call the 23.6. And it's this kind of exercise, it yields you the same ratios no matter where you are in the Fibonacci sequence. Obviously, a small exception are the first 5 or 6 numbers. You're going to get a much rougher kind of percentage levels or ratios. But as you progress through the sequence indefinitely, you are gonna get much more accurate, close to the 61.8, 38.2, and the 23.6%. Okay, once you do this kind of exercise of dividing, as we just mentioned. Okay, so how are Fibonacci levels drawn onto your chart? You're not going to draw them manually first and foremost. Let's begin by that. You have a tool on your MT4 platform that, or whatever platform you are using actually, that is up to speed, and it can be branded as a 21st century kind of charting site or platform, whatever that is. Okay. You have the indicator up and ready by themselves. So all you need to do is connect the lowest point, the highest point from what we call a wave to its lowest point, okay? Marking the 0 and the 100. You're going to see them in examples right now. For example, on the top left-hand side corner of the presentation slide, you have started up down here, down there, okay? Hopefully you see my mouse. The full completion of the move was up there, and the Fibonacci retracement tool was used in this kind of case, and it yielded, okay, by itself. That's the whole programming of the whole indicator. It gives you the levels, spits the levels out there, okay, and you can use them accordingly, okay? So Fibonacci levels are drawn by connecting two extreme points on a chart and dividing the vertical distance by key Fibonacci ratios, the ones we just mentioned. And these levels can act as key support and resistance levels in the course of a retracement, okay? A move, in a sense, what we call the definition of the term retracement, in a sense, is a move in the opposite direction of the prevailing trend. This is what it is, in a sense. This is what the retracement is. Another word for retracement is pullback. They use interchangeably or in different kind of manner, but still, that's the whole thing. You start from the beginning. You assume, and rightfully so, that the current trend is moving to higher ground. So it's an upward moving kind of trend in this kind of case. So therefore, you start from the bottom, you go to the top, and you expect, while using the Fibonacci retracement tool, to spit out any key areas or levels where you expect to see the pullback or the retracement, and then the continuation of the price action to higher ground. Okay, this is not used for complete reversal. This is used merely for a pullback. Okay, because it stems from the concept that markets trend in a specific direction until something severe happens, which switches, okay, to the other direction. And therefore, most of the times it's beneficial for you to trade with the trend, or at least follow the trend. Up until that point, you get signs that, you know what, this trend has stopped prevailing and another trend might enter the picture, or has actually entered the picture. For example, an uptrend is ended by a downtrend or sideways or whatever that might be. Okay, so in a sense, you assume that the prevailing trend will continue after this brief retracement. Hence, that's why you use the Fibonacci retracement tool to see where it's going to stop pulling back from, or where it's going to start retracing from, and then extending, okay, or continuing to the same direction, which is in this kind of case upwards. Okay, opposite cases on your right hand side corner. Okay, prevailing trend is after it's peaked. Okay, now I switched to downside. Okay, therefore complete move, you go from the top to the bottom. Okay, so the start is the 0%, something else I failed to mention. So wherever the first pin you put on your chart, okay, is the 0%, and the end of the marked area is going to be the 100%, and then you get the Fibonacci ratios in between the two extremes, the 0 and the 100. And therefore, from there on, when the price action retraces back from, okay, in this kind of case, it bounces to the opposite direction because it's downward moving trend. Okay, so this is what we call a rebound. Okay, it rebounded from the 38.2% level in this kind of case, and then it briefly, after a brief choppy session, series of sessions, it has extended its towards the desirable, not desirable, but the prevailing kind of trend, which is downwards. Okay. Okay, something else. 61.8% level is, if I'm not mistaken, at least in the eyes of not all, if most of traders, the most critical level, the 61.8% level, and the other two follow suit, the 38.2 and the 23.6 are the other two. But still, all of them play a key role. That's why we pay close attention to each and every one of them. Okay. Again, they are not predicting with 100% accuracy that the price action is going to rebound from or retrace towards to. They act as merely as another way of visually conceptualizing where we might get some sort of resistance. Therefore, do not use it solely as a tool on your own trading. Add other stuff to your chart. I mentioned this a million times by now. Use other indications to see whether they are converging, whether they are telling you the same story, or whether they're actually giving you different indications, and you act upon that accordingly. Okay, so how do Fibonacci ratios translate into trading? Fibonacci retracements are or is a method of technical analysis for determining support and resistance levels. And you know what we mentioned in the past, that support and resistance levels are not mere lines or accurate points on a graph that you expect the price action to bounce from. Treat them as ranges, okay, rather than accurate sniper-like prices. Okay, use them as ranges, and give or take, while using the Fibonacci retracement tool, you might get some sort of alignment between your already placed upon your chart support and resistance level. Once you plot the Fibonacci retracement tool on top of already existing support and resistance level, you might get some sort of alignment between the levels and criticalities and the severity of those levels, which gives you, again, much more confidence that your priorly selected levels with your naked eye are actually, quote unquote, decent. Okay, or you would reasonably expect to see the price action either stalling or pushing through. Okay, so they are named after the use of the sequence. We're talking about Fibonacci retracement here, or the ratios. Fibonacci retracement is based on the idea that markets will retrace a predictable portion of a move, after which they will continue to move in the original direction. Yeah, this explains the concept of overextension in a sense, and the reversion towards the mean. This is another principle that goes behind the rationale of using the Fibonacci retracement tool. Okay, and Fibonacci retracement is creating by taking two extreme points on a chart and dividing the vertical distance by key Fibonacci ratios, as we just mentioned. 0% is the initiation of the start of the retracement, and 100% is the complete reversal. Okay, once the levels are identified, horizontal lines are drawn and used to identify possible support and resistance levels. We're not going to go into funds and all the kind of other stuff. Stick to the basics for now. Okay, there are a lot of different other tools in regards to Fibonacci, not retracement tools, but has some sort of temporal applications to them as well, and slopes of prevailing trends and all that kind of stuff. I'm not going to confuse you or convey unnecessary information for this point in time. Let's stick to the basics. They are used primarily for setting up support and resistance levels. Okay, so give me 1 second, guys. How do traders use this information that is stemmed from using the Fibonacci retracement? As one of the most common or widely known technical trading strategies, traders use or could use Fibonacci retracement levels to indicate where they would enter or exit a trade in this kind of case. For instance, a trader notices that after a significant momentum or bullish action or bullish sentiment, a stock has declined 38.2%. As the stock begins to face an upward trend, they decide to enter this trade. Because the stock reached Fibonacci level, it is deemed a good time to buy. In my eyes, in my own humble opinion, that's a very crude way of going at it. Still, some people like to just purely and simply use only Fibonacci. You do you. Okay. Now, with the trader speculating that the stock will then retrace or recover its recent losses, some traders also combine other key data provided by indicators to confirm whether the expected move will be played out by rationalizing probabilistically rather than taking the levels provided for granted. And obviously, you can tell this is my own biased opinion written here on this lovely slide. Okay, so again, why use the whole thing by itself when you can add freely, easily, and after what 5, 6, 7 sessions we have been going over this, already comprehensible information by other technical indicators. Why not use all those kind of lovely stuff we just visited so far in the past, which gives you much more confidence, or not only confidence, but also high chance of probability of being correct? Yeah, that's my assessment. Please use them. There's no rational argument against it. If there is, please let me know. I'm open to switch my mentality and rationale if provided by evidence. Okay, so now let's go over a lovely and easy to comprehend visual illustration of what we mean about when we apply a Fibonacci retracement onto our charts. So what do we have here? Oh my days, my eyesight is getting bad. NZD USD, so Kiwi against the United States dollar, New Zealand dollar against the United States dollar. What is it? Daily chart, 4-hour chart. It's a very outdated example, but it serves the purpose of being a valid example of using Fibonacci retracement. That's why I'm using it. Okay, so start of the move, 100%. Okay, 0% to completion. Okay, so in this, given that we don't have any prior past action from here because it's a static image, it's a snapshot, we assume that the price action has been stalling near this level, and this is the first leg up or the initiation for the price action of moving to higher ground. So prevailing trend in this kind of, what is it, short term or for our chart, much maybe medium to kind of longer point of view, we have a upwards prevailing kind of trend indicated by this lovely green arrow pointing to upwards, or you can draw a trend line. I'm gonna do my gibberish scribbles on the chart right now. Please bear with me. Maybe something like this. Okay, you have 1 and 2 touches, maybe 3 touches here. So prevailing trend is definitely upwards. Again, trend line, you draw the trend line connecting the higher lows of the price action. Okay, where is the pointer? Give me 1 second. First initiation is here. Okay, higher high, another high here, but no high low. So this is a new higher low. Obviously, this level is higher than this one. This is a low. This is a higher low. And this is an even higher low, okay, after a new high. So definitely this is an upward moving trend. No need for the trend line if your eyes are trained, okay? Once you keep doing this for years now, you're going to, without the use of trend lines, you can understand where the market is moving towards to. But still, trend lines give you the ease of mind of having already identified the trend. So why not use it? Simple. So after we see the price action peaking up there, we draw a Fibonacci retracement too. And bear in mind that this has not, for example, yet happened. Okay, so we draw it from the bottom to the top, and we want to see, you know what, we see the price action peaking up here. Where will the next retracement level, or where the price action is going to bounce from and continue its prevailing trend, the upwards, after its brief setback? This is why we use the Fibonacci retracement tool. So after that, we see price action, okay, retracing to lower ground, and it does it in stages. Okay, and 2, 3, 4 touches. You see, now this is an intermediate descending kind of move. Okay, so the second wave, if we go into Elliott waves, this is the first one. If so, the first one and the pullback is numero 2, and the third one is the next leg up. So we are at the initial stages of the price action peaking there. So price action moves to lower ground. It breaks below after it bounces from this trend line. It breaks below this trend line. You get the confirmation that, you know what, the upwards trajectory of NZD USD has now been impeded or been pushed back. Okay, so the bears are actually taking control and they push the price action to lower ground. They are actually driving their retracement. That's what this break below the trend line tells you. Okay, in a nutshell. Now, henceforth, we look or we pay attention, given that we have plotted the Fibonacci retracement tool on our charts, where we would reasonably expect, given the Fibonacci retracement tool, to see some sort of consolidation or rebound or stalling of the price action to lower ground. Okay, you see some sort of congestion taking place near the 38.2% level. However, it doesn't manage to contain the bearish sentiment or the drive of the bears, and we see the price action plunging to lower ground, attempting some sort of consolidation slightly below the 50 level, which again is not a key Fibonacci retracement ratio, but we use it because it makes sense. Okay, so it's, in a sense, gives you an indication where has the price action retraced to. It has gone 50% lower. That means it's halfway there. That's why it makes sense. That's why we use it, even though it's not a Fibonacci retracement ratio key. Okay, we see some sort of consolidation and rebound taking place below, a little bit below the 50% level. And again, that's why I'm telling you, use support and resistance levels with a grain of salt, support and resistance lines. So we talk about areas here. And this would have made some sort of sense that you would reasonably expect to see some sort of rebound from there because of this. Yep. Now you can clearly see it. You see the price action bouncing from this level once, twice, maybe 3 times, certainly 3 times, maybe 4, okay, after the initial move. So this already, okay, before even placing the Fibonacci retracement tool, this would have been a valid support level that would expect the price action to bounce from. And you can see this here being actually playing out, okay? Near and above it, you see the rebound, the price action crosses above the 38.2% level, double top, 1 and 1, 2. I know I'm throwing a lot of things in there, but given that we've covered this in the past, I'm going to keep doing it. So, okay. So you see a double top, an indication that the price action, obviously you see a double top and a failure of the price action to break above this descending trend line, this intermediary descending kind of move, gives you another indication that price action is going to move to lower ground. You get the confirmation here. Once it forms what we call the McDonald's sign or the double top, you see picking once, picking twice, failing to break above the descending trend line, breaks once again below the 38.2 level and heads once again to the 50, and you see some sort of congestion once again. Okay, so you know what? You see the first signs of containment. On the grander scheme of things, you see that the bulls are actually engaged in the market and they are actually pushing back the strength. Okay, they are removing strength from the bears, or much more nicely said, they are clashing heads with the bears. Okay, they are not letting them dictate the pace, dictate the direction at the pace that they want. Okay, that's another way of conceptualizing price action. Okay, as a fight between bulls and bears is a tug of war. We've mentioned this in the past. Okay, so again, finding some sort of support, the 50, rebounding, but not breaking once again above this lovely level. Okay, and they stay below the 38.2. After this, the next and final, okay, line that we draw and we start paying significant attention to this is to the crucial 61.8, which is widely considered to be the most valid one, or the most, what would you say, accurate, might be, is not the exact word I'm looking for, but still, let's move on. Okay, so we pay attention to the 61.8. And what happens at the 61.8 after all this fight here and attempt to who's going to gain control of the direction? You see the price action breaking below the 50, coming down to the 61.8 and bouncing not only once, but twice. So we have the opposite case of here. This is what we call the double top. This is a double bottom. This is a McDonald's sign. This is a Wendy's sign. Americans and their burger franchises, they contaminate everything. Jokes, guys, just jokes. So you see the double top, a lovely indication that you might expect to see a reversal from here. Okay, this is what it conveys to you. This is what this formation conveys to you. We might have reached the end of the retracement, and a rebound and a reversal might take place. The pullback is possibly done, and the extension of the price action toward higher ground is going to continue. The original direction is going to be maintained after we have bottomed out. And this is, you see how I frame the whole thing? Possibly, probably, maybe, okay? Because we don't know. And when do we know for sure that, for sure, quote unquote, that the price action has indeed reversed? In my eyes, is when we see the clear, definitive break, not only of the above the 50 level, is subsequent, insignificant in this kind of scenario, is when we get the clear breakaway from the descending trend line. And the move surging definitively and much more confidently to higher ground. This is where I would declare, is a flag it. I hope this is a lame flag, but this is the area that, in my eyes, gives me much more confidence that this is a valid reversal signal. This is a valid double bottom formation. Once and if and only if, in this case, we saw the break above the descending trend line, which indicate the definitive break above the descending trend line, which gives you an indication, you know what, the actual move right now downwards has been impeded. A consolidation might take place, or at the best case scenario, a reversal has taken place. And in this case, it has, okay? And the confirmation after is a surging uninterrupted to high ground. In my eyes, is where I start placing long orders here and capitalizing on the extension of the price action of the main move towards the upside, okay? And from here on, we see it bouncing, consolidating and bouncing from it after the break, surging nicely, demolishing with little to no resistance the 38.2 prior, okay, resistance level, which now turns to support because we moved above it, okay, breaking the 23.6, but once again peaking and retracing a lot. Obviously, it's not going to do the whole thing like this. Price instruments in financial instruments in financial markets move in a zigzag fashion, obviously, so you don't expect to see this ludicrous vertical kind of move once and for all. So you would expect to get some minor setbacks, and we indeed had, but that's why we pay attention to it. Let's say we went long here, so buy, this is our buy signal. Oh my days, I was just messed the whole thing up with my scribbles. Yeah, so entry point would have been here. What I would start paying significant attention towards to next is when will be the next leg up or the next consolidation phase or the next higher low. So you can treat this as the new low, okay? When the next higher low will be formed. And hence we got the new higher high here, I would expect to get soon a higher low. And we got it somewhere in here. And this coincides nicely with the 38.2. Again, hear me out, coincides. It the Fibonacci retracement tool is not of predictive powers. It's not giving you any given certainty that, you know what, is going to bounce from. Okay. You pay attention to this kind of level just because it's a Fibonacci ratio. Okay. You need to see complete and utter consolidation above a specific level, whether it is near the 38.2 or the 50 or the 38 or the 61.8 or none of them. You need to see consolidation. So irrespective, okay, of the Fibonacci retracement tool, you will love to get a consolidation like this, a formation of a new low, okay, a new higher low in this kind of area to give you an indication. You have actually interpreted the whole thing, the whole reversal or the extension of the price action to higher ground in a much accurate fashion. Okay, this is the second indication, okay, that my assessment is correct and that the price action is reversing from this kind of level of the 68.2 or the 61 of the 61.8, and it's going to move to higher ground, and the major move is going to be extended into the future. And you see, when you start seeing the price action rallying once again after consolidation near this level, you have high chances of success. Okay, and you keep your long bias untouched. Okay, so you keep your long position open. Okay, or you might be in a much shorter kind of time frame and you have exited already the position. Fair enough. But still, it goes with your biases, if you will like. So we had a bullish bias in this case, and it actually confirms it. Afterwards, once again, second peak above this level. You see, which is a target area that I could have been set up as a valid exit point after I saw the first peak, second peak, okay, or another attempt to break above that kind of level would have been a possible exit strategy for me, okay? Or if I held on the whole thing, you see that it comes back near this kind of level, held nicely and rebounds again, okay? So this is one sole example of how you can use Fibonacci retracement and how you can plot the Fibonacci retracement onto your chart and pay attention to these kind of levels. In addition, okay, to doing your homework and drawing your lovely support and resistance levels in advance, and you anticipate and see where those kind of levels coincide with the Fibonacci ratios for much more valid or much more accurate kind of prediction, or having a much higher percent of confidence and higher chance of probability of making money. Okay, so you use all this in conjunction, and also bear in mind that we have not used any other given technical indicators. We just use Fibonacci retracement and support and resistance levels and trend lines. Okay, so basic stuff, and obviously identification of candlestick formations. Okay, double top and double bottom, easy stuff. Okay, we have not used either RSI or moving averages or moving average convergence and divergence or stochastic or momentum or none of these things. Okay, plainly using Fibonacci retracement. Okay, and support and resistance levels. Yeah, hopefully this whole example gave you the framework of thinking about these kind of things rather than just blindly opening a long order or a short order and just hoping for the best. Okay, go get into the mindset of creating these kind of probabilistic scenarios. Okay, and write down what you would expect to see and whether that actually happens, whether that coincides with your bias or not, and act accordingly. That's a much more sophisticated way of going out trading. And trust me, you're gonna, if you're not gonna make money, at least you're not gonna lose a lot of money. It's another risk management technique, okay? Making scenarios and carrying them through. Okay, obviously the opposite scenario is here, primary trend, okay? This is the top, this is the bottom, this is where we draw blah, 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 blah. Give me 1 sec. How much time do we have? Oof. I have to wrap it up. So let's do a live environment kind of situation together now, rather than going on the on a snapshot of a price chart. Let's do together an example. Okay, let me find something that would be nice to look at. Do you have any preference of what to look at? Please let me know in the chat, guys. Let me get my trading view up and running. What do we have? Do we have something ready? GBP USD. Let's go, Nata. Thank you very much. I have something already set up in place. Yep. Let's see. Please bear with me. There we go. So, whoop, let's minimize some things. Okay. So, where it go? Okay. So, here we have pound against the dollar, what we call cable. Okay. Let's go on a much shorter time frame, and let's, for the sake of the environment, because for the sake of the example, because we don't have much time, let's assume that this is the primary trend. So let's use, firstly, actually, let's go first with plotting support and resistance levels and see whether, okay, our eye is nicely trained to find decent levels, or whether those support levels that we're going to use are going to coincide with the Fibonacci retracement tool. Okay, let's do that first. So obviously, making a start, peak, I love this lovely peak there. This is the start of the move. This is the end of the move. So that's definitely 100, and this is 0. Okay, you're going to use them. This is going to be a support level. Let me draw it back to green. I love those colors. You can use whatever. Okay, so another area for me would have been this, even though it's far, far away. Resistance, another area would be, this is certainly an interesting level for me. Okay, which coincides from there. Once again here, slightly here and there. What about another resistance level? I'm going to place it below to this level right here. Okay, or maybe this area right here, you see. Okay, let's do another support. Where would you put support here? A much shorter time frame. I would put it somewhere here. Okay, but obviously there is one somewhere in there which is unclear because you see stalling of price action. Okay, so maybe I like this level, maybe here, kind of coincides with this as well. So again, it's a little bit way too compact, but still it will serve the purpose. So roughly plotting support and resistance levels using prior action. Okay, so if I zoom out a little bit more, you're probably going to get some sort of coincision with prior levels. You can see here picking once, picking twice, consolidating above it. Certainly an area that you would pay significant attention to. Up there as well kind of coincides with this whole thing, because you have peak, rebound, touch, congestion. Okay, visited area where you see price action bouncing nicely from. Certainly an area that I give a damn about. Okay, maybe this one as well. Okay, once, twice, 3 times here. Yeah, this is another lovely area. But now that we have very crudely placed support and resistance levels on this lovely chart, let's do Fibonacci retracement, start, the end, and in this kind of case, I'm going to extend it, okay, to see the levels much more clearly. Hopefully, we would have some sort of alignment, okay, between levels. Or, I don't like these colors. Let me remove it out of the way. So let's come a little bit much closer, okay? So the primary, intermediate, not primary, but the intermediate trend for the short-term kind of view is certainly a downwards moving trend. You can clearly see from here. And let me, for the sake of visual illustration, make it a decent line. Okay, so you have starting up there. Okay, this is not science, this is art. Okay, so start from there, failure to break once above it, twice above it, and finally it broke up from there. So from here, I start paying attention for a possible retracement to higher ground. Okay, so we have a bottom here. We have how many instances we have here? We have once, way too large. Okay, you have once, you have maybe twice here, and 3 times. You see it nicely. It nicely coincided with that. Come on. This, I'm moving out of the way. Okay, so certainly that's the one. Now, where are the Fibonacci retracement levels? We have the 23.6. Okay, kind of coincides relatively nicely to this level. Okay, the area that we have identified in the past. Okay, obviously this is not. And you see the 38.2 being another critical level, which is the one we just mentioned, that we may expect to see some sort of price action revolving around from. Okay, so if you go further back and you place it right here, somewhere in there, once, twice here, maybe here, definitely here. Okay, so this is an area where would you expect to see some sort of resistance. Okay, and this shall be colored red. Okay, so once again, we are currently near. Why are you bothering me so much? Let me do 14 to see him clearly. Yep. Okay, so we are currently near the 38 point, what is it? 6? Yeah, 38.2 level. Okay, so we would expect to get some sort of congestion or some sort of resistance or sort of ceiling near this kind of area, mainly using only Fibonacci, okay, retracement ratios. Okay, where is another area that may be coinciding? Yeah, 51. Obviously, eyeing the whole thing by itself with a naked eye, you can see that this kind of level is the half point of this kind of extended move. Top to bottom, 0 to 100, the 50 coincides with the peak here. Once, twice, 3, 4, 5 times here. Okay, certainly an area that will be paying significant attention to. 61.8, however, maybe has only one touch this, and this also coincides with the failure to break above the descending trend line. Okay, another area that we will be paying significant attention to. Okay, so what do we currently see here? Okay, break above the descending trend line. First indication that, you know what, this is going to be moving to higher ground. I want to see a confirmation and a break above the 23.6. We get this, okay, and you see a rapid price appreciation there, gives me an indication that, you know what, the retracement of this move, okay, may have been completed, okay, because we have multiple touches here. We have a break above the descending trend line, and then we have a surge of price action to higher ground. Gives you an indication that, you know what, pound dollar might be moving to higher ground. So therefore, let's assume that we're going to go long here, okay, because that's our assessment apparently, okay, where we will have our stop loss. I would love to have it near the 23.6 level, okay, mainly because it acted as a support in the past. Now it's gonna as a resistance in the past. Now it's gonna turn into support, hence the line we have here, okay. That would be my tolerance, so to speak, and I would be having an eye. Next short-term target would be the 50 level, okay, for me to exit the position. So risk-reward ratio 2, it's not that great, to be honest, but still, okay, given where we are, given that we missed this kind of rapid move, that's the best we can get now currently, given where we are, okay. And what would I need to see if I want to see my bullish bias or my bullish assessment coming into fruition? I would love to see the definitive break above this level in order to confirm that, you know what, we're going to get the full completion of the move, okay. So you see what I mean? Okay. So if I get the break above with a nice volume, a nice big green candle above the 38.2% level, next target will be 50. It all depends on how rapidly the price action is gonna develop, okay. But this is my base case scenario. I would love to see price action moving higher, breaking above the 38.2, and I will have my eyesight on the 50 level. If the volume is actually severe enough and nice enough and bullish enough, maybe I would have a trailing take profit. I will raise it a little bit higher and aim for the near the 61.8. However, it's a little bit overextended. We're talking about pound dollar. If something now I'm adding different parameters to the mix, and you will see, and not only technical, but I'm going to add fundamental ones as well. The whole move, this specific green candle, big green candle, came after a slight cool down of inflationary pressures in the United States. So this hurt the dollar severely. And if you pull up a dollar index chart, you're going to see the complete opposite move. So a big red candle at the time of the release of the US CPI print back on Tuesday, okay, which created this whole thing. So this is what I'm trying to make here from a fundamental standpoint of view. This is not strengthening of the pound. It's much more like the situation that is weakness in the United States dollar, because from a macro level, the dollar remains as a front runner, okay, remains in the driving seat of what's going on in the FX market. So that's what I'm trying to say here is, if we get news releases coming out from the United States that are actually decent, that are actually above expectations, that are actually nice, and that are expected to boost the dollar, the whole thing might be done within a day or two, okay? You would expect to see a retracement to lower ground, okay? Reversal of this short-term kind of upshot move, okay? If and only if we anticipate to get good news coming out from the United States. If, however, on the flip side, we have to take note of the whole thing. If on the flip side, we get deteriorating news from the United States economy, which are going to hurt the dollar, okay, this is going to go on our way, okay? And I'm not sure whether we can bet with a high degree of certainty that we're going to get deterioration from the United States dollar, because in my eyes, as an analyst, what happened on Tuesday was an excessive overreaction. We had a slowdown of 0.1% of the US CPI, okay? And the market went on the frenzy to call that the Federal Reserve is indeed done with hiking rates. We're not going to go into fundamental details much more here. What I'm trying to say here is that this move was excessive by nature, okay, from Tuesday, and in my eyes is abnormal. So therefore, I will hold a hesitant kind of stance of going all in when it comes to the pound against the United States dollar. But still, on the short term, this is what technicals are telling us, not fundamentals, technicals. So let me see the calendar below. What do we expect from the United States? What is coming out? Building permits, not going to move the whole thing. Fed minutes, certainly something that we'll paying significant attention to. When is coming up? Next week, probably. 21st of November, so Monday. So if we get this lovely report from the Federal Reserve, the FOMC committee, okay, and we get a narrative within this kind of documents saying that the US, the Federal Reserve, the central bank of the United States, is willing to push higher, interest rates to higher ground, do not be surprised to see this pair moving down here, okay? So because it's going to be significantly bullish for the United States dollar. If it's bullish for the United States dollar, it's going to be severely, or at least disproportionately negative for other currencies, much like the pound. And you would expect to see the pound dollar moving to lower ground on strengthening dollar rather than weakening pound. Obviously, the UK economy is not doing great. Currently, it's on the verge of a recession. So that's certainly something else to keep an eye on. But drawing conclusions mainly and solely from technicals and leaving the fundamentals out of the question, what are the technical indicators telling us? Moving beyond what we just stated with support resistance levels and the Fibonacci levels, the retracement ratios, let's take note of what other indicators are telling us. Moving averages, okay? What do we have? We have a EMA, exponential moving average, 12 period, and a 26. So the yellow one is the short one. The black line is the long one. What do we have here? If you remember what we said back onto the moving average strategies webinar, when you see a crossover, okay, between of the yellow line, okay, the short moving average crossing above the long-term moving average, you get what we call a bullish crossover. Another indication that the price action is going to move to a higher ground, okay? The trend is or has shifted, okay? So it gives you another indication that our bullish short-term kind of outlook or assessment is indeed valid, okay? So extra point here that we get the confirmation, okay, of the crossover between the short-term moving average and the long-term moving average. Certainly in our favor for a bullish case. We also see the two lines moving away from each other. Okay, that means the bulls are actually much more stronger than the bears, and they're driving the direction of the price action to higher ground. Also, what do we have below the chart? We have a lovely RSI reading of 60, the plain one, and the RSI-based moving average is at 54. Both of them are above the 50 cutoff point. Remember, 50 cutoff point, if you have values above 50, okay, that is certainly inside with the bulls. So bullish sentiment gives you another indication that they're driving the price action to high ground. And you also see, besides that you can see clearly here that let me use a different tool. Let me use this, I don't know what it is, curve apparently. So you see here down below RSI forming a lovely bottom, okay, Why does it not stay like this? Give me one sec. Forming another peak. Why are you bothering me? Messing with me. Okay, so a higher high, and you have another formation of a base here or another low, and nope, that's not what I want to do. Let me see. Another high here, and another formation, another low, higher peak, and you have this ascending kind of trajectory of the RSI. Bear in mind that is moving closer to the over bot conditions of the 70. Okay, something else to pay attention to, that you know what, if you actually get a nice rise of price action, you're going to get also a higher RSI value. Is going to fall outside the 70 borders, and therefore from there you would expect to see another retracement, possibly below the 38.2 and somewhere in here once again. So therefore I revise my take profit target a little bit lower than the original one. Okay, so because we're moving and we're edging closer to the 70, we adjust our take profit accordingly. And you can also bring up your stop loss near the prior peak if and only if you have not that much patience. Let's put it like this. Okay, so improves my risk reward ratio to 315. I like this better rather than the 2. Okay, so again, RSI below gives you an indication that the price action is moving to high ground. Excuse me, it moved away from oversold territory, rose up. Okay, and this was here, and this is what we call a nice divergence once again of price action and RSI. Okay, but it moves to higher ground, is again in favor of our bullish assessment in regards to pound dollar. So you have moving average crossover, a bullish crossover. You have an RSI between the 50 and 70, again bullish in nature. We see the breakaway, okay, from the descending trend line, okay, and the surge of the price action to high ground. You have a nice volume, okay, nice big green candles, okay, it gives you an indication that price action is going to move to high ground. What else do we have here? We see the Bollinger Bands, if they're not, because let me now we're going to see them much nicely. You see that the price action has broken above the Bollinger Bands, and hence, once we said about Bollinger Bands, when you see breakaways from Bollinger Bands and severe breakaways from the Bollinger Bands, you see opening here, like this candle opening here, closing up there, okay, way outside the Bollinger Band, the upper bound of the Bollinger Band. What would you reasonably expect from this is to have a sort of a pullback from the price action to return within the bounds, or what we call the reversion towards the mean. And also note that where is the midline of the Bollinger Band? Let me highlight it. Let me make it black. No, it's gonna mess up the whole thing. Let's do it purple. Let's do it like this. Wish. Okay. Okay. Now you can see also the midline of the Bollinger Band. Okay, which is down here, okay, far away from the price action. So you would reasonably expect to have some sort of movement like this rather than steep, but still. Okay, so once again, we see the price action flirting with the upper bound of the Bollinger Bands after its retracement back within the bounds. So this is another indication that, you know what, price action is eager, bulls are eager to push the price action to high ground. So how many confirmations do we have? We have 5 now. Okay, you have also what else do we have from the Fibonacci? Is just the support and resistance levels. What else can we find here? If I add moving average, convergence, divergence, let me see what we will get. Oops. Oh, sorry, let's do indicators. MACD, hopefully it's going to allow us. What is it telling us? Let me hide this for a moment. and have, okay, what is the MACD telling us? Yep. Where is it? There we go. So what is the MACD telling us? Once again, crossover between the lines, okay? Up until this point gives you an indication bullish momentum, okay? The bulls are actually in control and they're driving the price action to higher ground. You see the lines not crossing over still, okay? So they are in favor for our bullish kind of scenario. We see also the MACD line crossing above, okay, the threshold, the 0% level, certainly in the direction of the bulls. And we see also nice big histogram bars, okay? 6, 7 confirmation we got for a bullish. So when it comes, I said once again, when it comes to the, from a technical standpoint only, the indications for pound dollar are certainly falling with the bullish side and siding with the bullish side, okay? However, as I explained at the beginning of this whole rambling stuff I've done with pound dollar, let's not forget about the fundamental aspect of it, okay? And the fundamental aspect of it will be revealed to us once we get these lovely news releases coming up this week, upcoming week. This week is obviously done. We have, what do we say here? Building permits. I don't think it's going to move the whole thing much. Okay. FOMC meeting minutes, definitely something to pay attention to. And we have durable goods orders. Okay. So, yeah, in the grander scheme of things, we expect this to actually, okay, move in our way. So, in this kind of case, we have a bullish assessment when it comes to pound dollar. Okay. Let me give me 1 second. On the histogram bars, this is a question from Shiv. On the histogram bars, when they are above the horizontal line, does that relate to RSI above 50 level, vice versa when the bars are lower? Yeah, it's not exactly the same thing with the RSI and the moving average convergence divergence, but yes, in general, when you have the MACD indicator below your chart, okay, registering big green histogram bars, that's one thing that's certainly in favor with the bulls. Now, when we have the crossover of the moving average convergence divergence, the MACD line, above the threshold, because that was in negative territory, and this is representing the price action much more accurately. This is a sentiment, okay? Once you see the MACD line, if I'm not mistaken, this is probably the blue. Yep, the blue line, the difference between the 26 and 12. Once you see the break above, okay, the threshold, what we call the threshold, okay, you say the price action, okay, rising even faster because it moves, as you correctly pointed out, into quote unquote positive territory once again. But still, it's not exactly the same. It's the momentum with sentiment and the price appreciation, how rapid the price develops and all that kind of stuff, okay, that the MACD is actually conveying there. So yeah, in a sense, how to interpret this, once you see a crossover of a MACD line above the signal line, bullish crossover, it gives you an indication that might be a shift, or a shift has taken place in regards to the direction. Widening of the two lines, or distance between the MACD line, the signal line, growing further apart, bullish sentiment, okay? Big green histogram bars, you can see here, another indication that the sentiment and the momentum is with the bulls, okay? And the crossover is another lovely indicator that the momentum is actually rising even more severely and much more faster, okay? So gives you many different things, okay? But the point here is pretty self-explanatory, I just mentioned, okay? So, guys, unfortunately, we're running out of time. we have to end this session. If you have any other given sort of questions, please send them through as soon as possible. Or if not, have a lovely weekend, and we'll see you back. I think we're going to do the next webinar the first week of December. Next week, I'm going to be off. So enjoy your trading, and hopefully you understood what the whole topic of Fibonacci retracement was. Okay, pretty self-explanatory. In a nutshell, you use the Fibonacci retracement as hopefully finding levels where you can expect to see some support or some resistance, and you judge by that whether you can use that as an entry or an exit point, and all that kind of other lovely stuff we just mentioned. Okay, thank you, much appreciated, Nata. Thank you, guys. Hopefully catch you soon. Okay, take care. Bye-bye.